Good day, participants. Now, continuing with our chapter number 9 of CFP2, that is risk management and insurance planning subject. We will be talking about the need analysis. As you know, there are three approaches for the need analysis. One is the HLB approach, that is the human life value approach. The second approach is the needs approach itself. And the third is the capital retention approach, which we also call as capital liquidity need analysis approach, or CLNA approach, capital liquidity needs analysis approach. Earlier we have already discussed what is human life value approach and what is the needs approach. Today we will be talking about the capital retention approach. Well, we had seen in the human life value approach that we calculate the future earnings of an individual, and we calculate the present value of the accumulated future value earnings of a person. And we don't take into consideration the effect of inflation. We do not take into consideration the family size of the person, the family circumstances, the needs of an individual. So it is having its own advantages as well as disadvantages. Advantages in the sense that it's a very simple method, and sometimes that we can make a thumb rule also that okay, the life insurance cover should be say 10 to 15 times of the earnings of an individual. So several thumb rules regarding the age of the person has also come into use practically. Basically we say that if a person is 20 to 30 years of age, then the life insurance cover can be 10 to 15 times of the annual earnings of this person. If the person is in the age bracket of 30 to 40 years, then the life insurance cover can be say 8 to 10 times of the annual income. If the person is in the age group of 40 to 45 years, then it could be even 7 to 8 times of the annual income, and so on, and it goes on reducing the multiplication factor as per the age of the person. So that way, this is the most prevalent method which is used in the marketplace. Then needs approach, we take into consideration the various needs of the person. What are the capital needs of the person? What are the special needs of the person? What are the family or income needs of a person? What are the education needs, emergency funds, etc., etc. Then when we take into account what are the present funds, present investments done by this person, and then the balance of the needs is the amount of life insurance cover required of this person. So this is again a simpler method. But here also we have not taken into consideration the effect of inflation. And financial analyst says that this method has got disadvantage in the sense that you are calculating, yes, this is X rupees is the amount of life insurance cover needed by this person. Now in case of this happening with this person, the family will get this X amount and they will spend it. What happens if they spend this X amount which is meant for next 5 years, they spend in just 1 year? So what will happen to the next 4 years? You have not made any provision for any kind of regular and permanent income for the family. So in order to remove this kind of disadvantage, in order to mitigate the disadvantage of this approach, analysts have come out with another approach which is known as capital liquidity need analysis, which we are going to discuss today. Capital liquidity need analysis, number one, in some sense the approach is similar to this needs approach, because we want to calculate first of all what are the liquid assets possessed by an individual, number one. But number two, we want to calculate amount which we can call as capital, which will be retained by the family, and the family would be able to earn an interest out of that capital. So that amount of capital we have to calculate what is the amount of capital required by this family, and that amount of capital should be the life insurance cover on the bread earner of the family. So this is what we calculated under this method. I think we will understand this approach by a small example. So we will take a small example from our text only. This example says that one person, Mr. V.K. Duggal, whose age is 39 years, has a wife and 2 children, ages 10 years and 6 years. And the earning of Mr. Duggal is annual earnings rupees 6 lakh per annum. Mr. Duggal says to the financial planner that if he were to die, he wants his family to receive at least 3 lakh annually, because that would be the family requirement to run the family. Or sometimes the financial planner asks the person, what do you consider are the basic family expenses, or what are the basic livelihood expenses to maintain your present standard of living. So generally, a person will deduct, the earning member will deduct his own expenses. If he were not there, those expenses would not be borne by the family. What would be the other expenses? So it's a rough estimate. So let's say the family expenses after, you say, Mr. Duggal, if he is not there, would be 3 lakh per annum. Now, here also the financial planner would ask whether there are any special needs of the family. Here we don't ask the segregation of all the needs, like we did in the needs approach. What are the income needs and all? No, we just want the basic family needs. Then any other, say, emergency fund or educational fund, or any kind of educational fund for the children. Here Mr. Duggal says, in combination, emergency and educational fund, he says, I would like to have 2 lakh rupees for the family. Family should have of 2 lakh rupees. Okay. Now, what the financial planner would do here in this case, basically it's a more comprehensive approach. The financial planner would like to know what are the assets possessed by the client and what are the liabilities of the clients. So the financial planner will have to be in the questioning mode. So one needs to have the estimates of the various assets. Now let's say Mr. Duggal says he has a house worth 20 lakh rupees. He has got a car and a two-wheeler. The cost of them today would be, he says, 3,50,000 put together. In saving accounts, he has different savings accounts. He has around 1 lakh rupees. He has some investments in securities. Other securities and investments, we can say, is in all 5 lakh rupees. He has an individual group insurance and also he has got some group insurance from his company. So club together individual and group insurance on him amounts to rupees 10 lakh rupees. He says he has a family jewelry worth 4 lakh rupees, and the financial planner takes into account all sorts of assets possessed by this person, whether movable or immovable, fixed or liquid. Household equipments. Household equipment means all kinds of household gadgets and appliances, etc. Worth 2 lakh rupees. Now, what about liabilities? He says he has a mortgage on the house, which is of 8 lakh rupees now. He has other personal loans, oblique some credit cards, loans, 50,000. That's all are the liabilities of this person. Now we have to calculate what is the amount of cover required by this person based on this data by, say, capital retention approach. Now what the financial planner would do, see, these assets, if you add them, they would come out to be 20 and plus and all these things. But as we had discussed in our earlier session, that in financial planning, the financial planner will not consider the fixed assets, because that would not be a prudent thing to do. We cannot say that, okay, if you are having a house worth 20 lakh rupees, then tomorrow the family can sell off. Where the family will live then? So we don't have to part with the present assets. Yeah, if the person possesses any other property other than house, any other house, if the second house would have been, then we would have considered them as the liquid assets. A spare property, we call it. So let us segregate the fixed assets and the segregate assets out of this. Now this house is fixed assets, saving accounts is liquid, this is also liquid. Individual and group insurance will convert into liquid assets because we are considering for life insurance, so we'll take them as liquid assets. Household expenses, what you would say, liquid assets or fixed? Family jewelry, fixed assets, not liquid assets. Why?
It is not easily convertible into cash.
But it is said that gold, silver and all, they are easily converted into cash.
Yes, sir. Yes. It takes a time.
Whatever time I mean, 2-3 days you go to a jeweller's market and you can get the cost and today's prices, whatever, because it's not gold biscuits or that, it's a jewelry, so they will deduct some amount of money, but they will calculate how much of gold or silver, whatever it is present in the jewelry. But they will give you, otherwise, so, but you are right, I just wanted to interpret this, basically gold, silver and any kind of jewelry is a liquid asset. But here, in Indian context, if you are talking about, you would appreciate that in Indian context, family jewelry is something which normally passes on from one generation to another generation. Normally, if a family possesses some jewelry, maybe this is the family, maybe this jewelry might have been given by the, normally jewelry is possessed by ladies in India, and most probably this jewelry would have been given to her by her mother or by her mother-in-law. And generally the Indian tradition is that they don't want to part the family jewelry. They will convert from one kind of design to another kind of design. That is another thing. But nobody wants to sell the jewelry because that is considered as the most contingent situation in the family. That one has to sell the jewelry. Whether people wear them or not, they may keep it in lockers, but they do definitely wear them on marriages, on functions, on occasions. And nowadays even boys also are fond of jewelry. They also wear all kinds of chains and rings and etc. etc. So therefore we will consider it as fixed because family emotions are attached to it, family traditions are attached to it. So we will not say that okay, you will sell this jewelry. Isn't it? So this should be with the family. So okay, now we will consider only the liquid assets. So liquid assets, if you add them, one, this is also fixed, yeah. 2, 3, only 3. So 5, 6, 16 lakh, isn't it? So 16 lakh are the liquid assets. Rest are fixed assets. We will not take into consideration the fixed assets. Okay. And what are the liabilities? Liabilities are 8 lakh 50,000. Now, what we will do in this approach, in the question, students would be given that capital, what would be the percentage on which capital retention approach has to be calculated. For example, in this question, they have given that you have to calculate the capital retention approach at the rate of 6% interest. So anyway, this is just an example. A car loan was also there, that is 1 lakh rupees. So total liabilities are 9 lakh 50,000. So we will deduct 16 lakh. We will take 16 lakh as the liquid assets and we will deduct 9 lakh 50,000 from this. So net liquid assets would be 6 lakh 50,000. Are the liquid assets now currently, we will say, these are the net liquid assets possessed by the family. Less, this person wants that there should be a provision of 2 lakh rupees for the educational fund and 3 lakh rupees for the funeral expenses after Mr. Google. Even if we, for a moment, let's make it more practical. Let's omit this. For example, he says that I want only 2 lakh rupees. Let's make it more practical because this. No, those are not funeral expenses, these are family expenses, sorry. So, 6,50,000 we will reduce this, first of all let's reduce this 2 lakh rupees, this is 4,50,000. Rupees are the liquid assets, let's say, because he wants to keep aside these are the funds. Now, in capital retention approach, we say that it is assumed that the capital, that is liquid money of rupees 4,50,000 would be invested to earn 6% annually. If the percentage is 6%, then how much would be earned? If this is the liquid assets, what would family earn? Family is not supposed to spend this 4,50,000 if Mr. Dubey is not there. So what they will earn at the rate of 6%. So at the rate of 6%, if you calculate, it would be 4,50,000 at the rate of 6% comes out to be rupees 27,000 per annum. If it is more, if it is at the, if you are assuming the rate of 8%, it would be more. But here, probably it has been considered that probably then it would be invested in safe instruments like bank deposits and all, which will yield maybe just 6%. So the return would be just 27,000. Yes. No, sorry, we will not omit this. Now let's say, but the family requirement is 3 lakh rupees per annum. So how much is the shortfall? They want 3 lakh rupees, but they will earn only 27,000 rupees. So the shortfall is 2,73,000. So that means 2,73,000. What we will do? We will do the reverse calculation. We are assuming an interest of 6% that it will be earned. So to earn this money, how much capital is required? So we will multiply it by 0.6%, that is 0.06. That is 6%. So how much capital is required? Divided by. So this will be 45 lakhs, sorry, 50,000.
50,000, yes.
So this approach says that this is the capital required. If the capital is earning at the rate of 6%, and this is the capital required by the family, and so this should be the life insurance cover. Because if this capital is invested, this would yield an income of 2,73,000. The family already possesses this much amount, net amount, because they have set it aside, this emergency fund. Had this emergency fund not been there, then we would have calculated on 6,50,000. So, I mean, you can do other calculations also. If somebody wants to say, let's take 10%. For example, if you consider that yes, now interest rates are increasing or mutual funds instruments are also there. Let's say we are investing it and let's not consider this 2 lakh rupees. Then the net capital to the family is 6,50,000 at the rate of 10%, then it would be 65,000 to the family. So the family needs 3 lakh. So if you reduce 65,000, it will be 235. Now, if you are considering 10%, then let's divide it by 0.1 at the rate of 10%. Then it would come out to, just calculate, 2,35,000 divided by 0.10.
23 lakh 50,000.
23 lakh
50,000.
50,000. This is more practical amount. 23 lakh 50,000 is amount of insurance. Because that was just a question we had considered. If we are considering a fixed capital amount, that is, we want to make this capital as the asset of the family. Then education fund and all will also be extracted out of this income. Because once you have assured that the family will be having regular income, let's not consider that educational fund. That will be more, I mean, practical if practically we are going to a customer. This 3 lakh rupees is also perfectly, I mean, this is a very normal amount, living expenses for a family. So this is the amount of cover. Although capital needs analysis approach also tends to calculate a bit higher amount of life insurance on a person. But these are all different approaches. Here it says that a person's assets are like a siphon. A person has got different assets. This is house, this is say all other fixed assets, this is investments. But when they go reach a person, they reach a siphon. So as the time passes by, this siphon becomes narrower and narrower. So what you receive is just the trickled amount. So this amount is basically, they want to calculate the regular income out of this, which would be 3 lakh rupees. So they say, okay, after utilizing all that capital, you should get this, and you should ensure that for the time to come, this family will get this amount. And basically, if the children are small, so by the time they will grow up, they will begin earning. So the family's obligations would be fulfilled by this particular amount. So here you have seen that in capital needs liquidity approach, the fixed assets are left untouched. Additionally, some of the income that is generated out of the liquid assets, we consider that it would be reinvested after clearing the debts to permit capital growth and subsequent income growth also. So therefore we have seen all the 3 kind of approaches to calculate the life insurance on a person. Ultimately, a financial planner has to see in totality. If we are talking about the financial planning as a whole, then that's why we will be studying different subjects like investment planning, like financial planning, like retirement planning. So a financial planner has to take a holistic approach. Insurance salesman would be the person who would say, yes, you invest all your spare funds into taking insurance. But a financial planner will say that, okay, you should not keep all your eggs in one basket, you should diversify your portfolio. You should invest something for your retirement plans also. You should invest something, first of all, you will see whether adequate risk of the person is covered or not. Not only life insurance, you will also see whether adequate insurance has been taken for the fixed assets as well, against fire risk, against any accidental risk, against any contingencies, disability risk, medical risks, and then what would be the return earned, what are the current returns earned by the person's investments. If the returns earned are a paltry, say 5% or 6%, then it's the duty of the financial planner to suggest that yes, you should invest in those instruments. If you are ready to take a little bit of risk, then you should invest in those instruments which will yield you a greater returns. Okay, thank you participants.